Hey everyone, this is part 3 of the CGT slides. So where we left off is we'd gotten to paragraph 3 because we'd done paragraphs 1 and 2. And paragraph 3 is just, and 4, this very simply describes what a capital gain and what a capital loss is. A gain is when your proceeds exceed your base cost, and a loss is when your base cost exceeds your proceeds. Okay, just a reminder that you can see the 4 elements that I said are going to be key earlier. An asset, disposal, proceeds, and base cost are what you need to determine whether there's going to be a capital gain or a capital loss. We've done assets, so we know what type of assets are subject to CGT. We're going to look at proceeds and base cost in more detail later, but we know the basics, which means the next thing we need to look at is what is, I'm actually going to get in 2 slides, but what is a disposal? Okay. When we get to paragraph 5, it tells you about your annual exclusion. Paragraphs 6, 7, and 8 speak about the aggregation rules, basically how the process that you use each year to add up all your gains and losses, take off your exclusion, and take off anything from the previous year. That's covered in paragraph 9, how you deal with a capital loss, and paragraph 10, the 40% and the 80%. So paragraphs 5 to 10 are effectively covered by this slide over here. If you understand this, then you understand paragraphs 5 to 10, and you probably don't need to highlight anything. Okay. Great. Then we said we've done assets. Now we need to look at what a disposal is. A disposal: any event, act, forbearance, operation of law which results in the creation, variation, transfer, or extinction of an asset and includes A to G. That's a lot to say, and I said it very quickly. Basically, it's anything that results in you getting rid of ownership of an asset. Okay. Some of the easier ones: sale, donation, expropriation means it was taken, conversion, granting, cession, or exchange, forfeiture, termination, redemption. They've got every word here just in case. Scrapping or loss, so if the asset is destroyed, that counts as well. Distributing the asset to the holder of shares, so a dividend in specie, that would be a disposal. Okay. The key things then is it tells you afterwards certain things that are not disposals. Okay. The most obvious ones are the following: any asset, okay, which is used as security for a debt, that is not a disposal. Okay, so where you simply give an asset to somebody as security, it's still your asset, you haven't disposed of it, that doesn't count. Okay, you can read through this list. I think it's useful maybe having a quick read through, but you're not going to find too many of these examples. Okay, another one: the issuing, cancellation, or extinction of a share in a company, not a CGT event. Cool. Now that's actual disposals, but as always, SARS has certain types of deemed disposals. Now, these are found in paragraphs 12, from paragraph 12.1 and 2, all the way to paragraph 12a, and they are deemed to do the following. Now, this deemed disposal, what happens is you're deemed to dispose of and immediately reacquire by the same person the same asset at market value. Now this is going to sound a little bit weird. You are deemed to in effect sell the asset to yourself at market value on the day any of the following things happen. Now, why would SARS need to do this? Why would SARS need to deem you to sell the asset to yourself at market value and then acquire it at market value at the same time? Basically, what is going to happen in these scenarios is these are scenarios where SARS wants to reset the base cost. So you may have bought the asset a while ago. SARS wants to reset the base cost. So you're deemed to sell it. It's going to trigger CGT with the proceeds being market value. And then you buy it back, and that's going to be your new cost for the asset. It's used as a way of resetting the base cost because of certain scenarios that you're going to see now. The first one: when you commence being a resident, okay, you are deemed to dispose of all of your assets at market value. I'm going to get to the except now. So now, why do you have this deemed disposal of assets when you become a resident? Remember, a non-resident only subject to CGT on South African immovable property and that 80% rule, stuff like that. But any other assets, they're not. Now, you can't have a situation where somebody has an asset in, I don't know, Australia for 50 years. All the growth in the assets happened there. They move to South Africa, become residents, and sell that a day later. All of a sudden, South Africa, if nothing changed, would be entitled to all the CGT on all of that growth, even though that happened in Australia when they were Australian resident. So what happens is SARS deems you to, on the day before you became a resident, so when you're still a non-resident, you sell that asset to yourself, it resets the base cost, and your new base cost will be the market value on that date. Any gain that I'm going to make it bigger here so you can see, any gain that you made on that asset would happen when you were a non-resident. So for South African CGT, it's not subject to it. Okay. Anything that happens afterwards, your market value on the day you became resident will be your base cost, and any growth from that day will be subject to South African CGT. And that makes sense. Okay. Remember, this is a deemed disposal, so there's no actual transfer of assets. It's just deemed for tax purposes, and it's only deemed for SARS purposes. Australia may have their own tax rules that we don't know about. We don't need to know about them. Unless you plan to immigrate to Australia, then you should probably learn them. But we don't know about them. It's not part of our syllabus. So Australia will do whatever they want. They'll probably do the same thing so that they can get their tax before the person leaves. Because then that gain of the 50 years until the day before you leave Australia will most likely be taxed in Australia. But that's not part of our issue for now. So when you become a resident, you're deemed to dispose of all your assets and reacquire them. The only exceptions? Any South African immovable property or assets of a permanent establishment. Why? Well, the issue is those are going to be subject to CGT regardless of what your residency is. So you don't actually need to do this, resetting of the base cost. They were always subject to CGT. They still are going to be subject to CGT. Okay. B, 1 and 2 speak about something becoming a permanent establishment or no longer being part of a permanent establishment. It's exactly the same as above. The only difference is that it's just dealing with permanent establishment. I wouldn't stress too much about that. Okay. What I would talk about that actually isn't on the slide, that should be on the slide, is also when you cease to become a resident. So when you become one, great, you're deemed to dispose of it. But when you stop becoming South African resident, the exact same thing happens. Okay, so I can't change it right now. I'll change it on the other one. So commencing or ceasing to be a resident. The reason here, again, you may have had an asset in South Africa for 50 years. You can't just then move to a country that has no CGT and then decide, hey, cool, I'm selling it now, no tax, I'm done. So I was just like, we want our money. So before you go, you're going to be deemed to dispose of all of your assets at market value, and SARS is going to want the CGT on those assets. Actually, generally, sometimes before you even can get your visas or passports or the documents to move to another country, they want approval from SARS, and before SARS to give that to you, they want CGT on all of these assets. Now, for most of us doing this course, if we were to ever move overseas, we don't really have too many assets. It may be, car, personal use, cell phones, personal use. Maybe we own a house. In that case, there will be CGT, but we've got the primary use exclusion, so we wouldn't really have to worry. But if you're a high net wealth individual and you want to change your residency away from South Africa, there's going to be this huge charge because you're deemed to dispose of all of your assets at market value, and you'll have to pay the CGT on them. So think about somebody who's extremely rich, owns lots of shares. If you were to switch your residency away from South Africa, there will be this deemed disposal and you're going to owe a lot of money to SARS. That's sometimes called an exit charge. The price you sort of have to pay for leaving your residency in a certain country. No country is ever going to make it easy to leave the residency, because then you're going to no longer be subject to their taxation. Okay. So those are your deemed disposals. Other deemed disposals that function in exactly the same way: any assets that are transferred to trading stock. Okay, so if an asset that you own was in trading stock and it becomes trading stock, there'll be a deemed disposal. Exactly the same for anything, okay, that goes to capital that was trading stock. If it's going to trading stock, what you're going to deem to be done is that you're going to sell it at market value. There's going to be a gain, with market value being your proceeds and whatever you paid for it being your base cost, like normal. Okay, so you're going to have your CGT, and then you're deemed to acquire it. Okay, but now you're acquiring it as trading stock. So you would think this would normally be a Section 11A, but because there's no actual expenditure, it can't be a Section 11A. So SARS will let you include it under Section 22(3), which will basically stick it into opening stock and allow it to be a deduction. So that's if something's going from capital to trading stock. If it's going the other way around, you're going to have a 22H recoupment that we learned about in trading stock. Okay, but the deemed reacquisition will set the base cost for any future CGT, because obviously you're going to want CGT on its growth in value from the day it became capital until the day that you sell it. The exact same thing happens for personal use assets. If something is a personal use asset and it becomes a trade asset, let's say you take your home computer and decide to use it in your office instead, deemed disposal at market value, deemed reacquiring, so it's going to set off the CGT. Because it's going from personal use, any gain or loss that you make will be disregarded, and going forward, your base cost will be whatever market value was on that date, so you will have CGT going forward. The exact same thing in the opposite. So if it was trade and it becomes personal use, deemed to sell and acquire on the day it changes, there will be a gain or a loss before, but then afterwards, any gain or loss will be exempted because it is now a personal use. A good example of this is given to you in the textbook. And in this example, we have a scenario where property changes. Okay, so it changes, if I remember right in this case, it changes from being capital in nature, speculative, to being revenue in nature or trading stock. You're given the dates, you're given the costs. You need to basically now see what happens when something switches from capital to trading stock. The key things, well, on the date of this change, there's a deemed disposal at market value. Your base cost is what you paid for that asset, and any difference is going to be CGT. Okay, there's your net capital gain at 80% because it's a company, no annual exclusions, and there's no other gains or losses in this scenario. What then comes afterwards is, remember, I'm going to go back 2 slides. This was something that became trading stock. So you're deemed to, in effect, acquire this stock at 1.5 million, the market value on the day of the change. You can't get a Section 11A because there's been no actual expenditure, but Section 22(3) says, hey, wait a minute, you can include it in opening stock. There's your deduction. The same rules as always apply. It hasn't been sold at year end, so it has to go into closing stock and get added back. Don't forget your taxable gains from above, and there's your taxable income. If this had been sold in the year, you wouldn't have closing stock, and you would have some line called gross income sales for whatever you sold it for. I hope that makes some sense. In the next video, well, actually, I'll ask it here, okay? How would you answer change if you actually sold it? And can you deal with it in the reverse? where we're going after this is we are going to start looking at section 12 or paragraph 12a.